Welcome back. Now, Capitec Bank has reported an increase in annual profits of 15%, but shares in Capitec fell by more than 6% earlier. There you can see the plunge after it reported that many consumers are struggling to keep up with their debt repayments. Total net credit impairment charges on loans and advances rose by a whopping 80% to more than 6 billion rand for the year that ended in February. That offset a 12% growth in income from operations. Capitec now is South Africa's largest retail bank by consumer numbers, and it banks about a third of the entire population. In fact, to discuss, we're joined by the CEO Gerrie Fourie. Excuse me, Mr. Fourie. Let's start with the good news, which is better profits. And you've said that you're proud of what the bank managed to achieve. Tell me more.
Yeah, I think if you grow with 15% in this tough economic environment, you've done exceptionally well. I think if you underpin that with the 800 million that we've actually given back to clients, as well as our 1.4 billion rand investment in future projects that we're busy with, I think it's a very strong performance. You know, our earnings could have been much higher if we kept that back, but our whole philosophy is long-term, looking at the client and making certain we invest in the future.
To what extent are better profits due to higher interest rates? Is what many of us dread as ordinary South Africans a gift for you?
No, it's got a positive impact, but it's in our case, in last year's results, is about 150 million, so it's very small if you look at the total income levels. I think, a lot of people talks about interest rates, and I've just been talking this morning to a couple of people. We must remember interest rates are basically now about 1.5% higher than pre-COVID. If you compare what's happening in the economy, one needs to look at before COVID, what happened in COVID. Interest rates were dropped, and now interest rates was hiked up again. So it's important, or even inflation, you need to look at it pre-COVID and after COVID.
The bad end of the stick, as it were, is that consumers are struggling to pay back. Can we just cut through the jargon? What do you mean by impairment charges? Many people know bad debts, where people simply cannot pay. Just explain that category.
Yeah, you mentioned the 80%. Again, if you look at that 80%, you need to look at it in contents. If you look at last year, we had a very abnormal low year. If I go back to 2020, our impairments was about 4.5 billion. Then the year after with COVID, it went to 7.5 billion, and then it dropped last year to 3.5 billion, and now it's at 6 billion. It just shows you how it moves with whatever is happening in the economy. So it's a very low base that we're actually coming from, and that's why we're not that concerned. We have shown that there is stress on the client, and we're monitoring that very carefully. And we've taken appropriate steps to make certain that clients perform within our risk appetite.
You say you're not concerned, but we're talking about an almost doubling of those impairment charges. Are your checks and balances in place?
Yeah, again, you emphasizing the 80%. Again, look at it over a period. If we look at the 4 billion in 2020, compared to 6 billion now, and our book has grown with 27%. It is higher, but if you take it in a relationship, it's grown actually slightly higher than the book. In total, it's grown about 1.5% more than what, if you compare it with this year with previous years. And that's where I'm saying we have taken the necessary steps, and we believe our credit appetite is in line. I think the question is where is the economy going to go, and what's the real impact on the economy? I think the $1 million question that nobody really can answer is load shedding, and what is happening with our infrastructure, and what is happening with logistics, Transnet. Those are the things that is not anticipated in the economy.
Well, you've preempted one of my questions, because you deal with so many customers now. So surely you get a real sense of the strain that they're feeling because of the higher cost of living, because of interest rates. And I was going to ask you, where do you think it's going? So are you saying it's hard to tell?
No, I think if you look at what all economists is predicting is that inflation in the last quarter of this year will normalize. We've already seen now with America inflation rates drop from 7% to 5%. We've seen similar trends in UK. So it's going to be interesting to see what the Fed does in America, because normally if the Fed don't increase the interest rates, our interest rates won't go up. Our inflation figures are coming out this week, and it'll be interesting to see if it's actually come down, what we're seeing on that side. So hopefully, if you look at all the economists, they're predicting that inflation, interest rates, cost of living will normalize at the end of this year. So one will have to see how it pans out.
All right, finally, we're running out of time. Tell me what Capitec customers can expect, because you have suggested two things. One, that it may be harder for people to get credit. Are you going to be more cautious when extending credit? And also, it seems like you're trying to back off this huge customer base and sell things like the insurance business offerings. What can be expected?
Well, we've said we've invested in the future. So 4 of the 5 divisions in Business Bank has been rebranded. We're busy now in April and May rebranding Business Bank, and we see a lot of opportunities in that space. We've got our own insurance license, so we're busy migrating our insurance portfolio onto our own license. Then we've got value-added products, or what we call VAS, that's grown over 30%. We've got Capitec Connect. We've got Live Better. So there's quite a lot of value creation that we're creating for our clients, which makes us optimistic about the future.
All right, thank you for your time this afternoon. That was the CEO of Capitec Bank, Gerrie Fourie.